Hello and a warm welcome. It is a new year, a new accounting year for most companies. Limited liability companies are required to register for tax and file their audited accounts and tax computations with the Federal Inland Revenue Service within 6 months of their financial year end on a self-assessment basis. Such companies must file the following documents with the FRS on an annual basis: tax computation for the relevant year of assessment, the audited financial statements for the respective period. This should be in conformity with the International Financial Reporting Standards, IFRS, a duly completed and signed self-assessment form for companies' income tax, and evidence of remittance for companies' income tax. However, for individuals in paid employment, you and I, our taxes are deducted from our salaries or wages by our employer and remitted to the relevant tax authority, which is the Internal Revenue Service of the state of residence of the taxpayer. That is what is known as pay as you earn, payee. The due date for remittance of pay as you earn is the 10th day of every succeeding month. Talking about self-employed individuals or entrepreneurs in general, the tax they pay is known as direct assessment, which is the second leg of personal income tax. Direct assessment is our focus on today's episode. Self-employed individuals or those in partnership, professional service providers, lawyers, accountants, realtors, surveyors, and those we generally refer to as one-man business. It is expected that these categories of taxpayers will, without notice or demand, file a return of income earned in the preceding year and pay the requisite personal income tax to the State Internal Revenue Service where the business owner is resident. The due date for filing returns and remittance is the 31st of March of every year. Joining us today on this episode is Mr. Igho Orienru, the Assistant Director of Personal Income Tax at the Lagos State Internal Revenue Service, and he will be filling us in on what we need to know on direct assessment. Mr. Orienru, welcome to Tax Matters.
Thank you, Amaka.
Sir, under Personal Income Tax Act, personal income tax is divided into two: pay as you earn and direct assessment for individuals. And today we want to look at direct assessment. What is the distinction between payee and direct assessment?
For personal income tax, we have an act, which is the Personal Income Tax Act, which mandates states' internal revenue services, that is the different states, they have their internal revenue service, to assess and give tax liability to individuals. So the individuals, those who are in paid employment, those who are not in paid employment. Those in paid employment, they are payee, just like you said. The deductions are made by their employers, which they remit to the State Internal Revenue Service. But for self-employed, they are paid under direct assessment. There are different categories. Sole proprietor. When I mean sole proprietor, those running their own business. It can be just himself. If he has 1 or 2 employees or a few employees, and it's an enterprise, not a limited liability company. Okay? And it may be a venture. Fine. They pay. All right? Professionals. Maybe an accountant, a medical lab scientist, and he's running his own business, and it's also an enterprise. He also falls under this category. Then we have trustees, we have executors, we have administrators on behalf of estates, on behalf of their principals and their beneficiaries. They also file in and they pay tax. Then we have partners in partnership. The partnership do not pay, but the partners in the partnership, at the time they've declared their profit, each of them will pay according to their respective profit sharing ratio which they are also being given. Non-executive directors of companies, all companies, whether limited liability or not, because they are non-executive, they cannot be on the payroll. It is the executive directors who work day-to-day that are on the payroll, and they're filing and be assessed under direct assessment. Now, how this works is, direct assessment is an assessment, that is computation of tax liabilities that the individual is supposed to pay. When I mean individual, I'm referring to sole proprietors, those who run their own businesses or who have enterprises but not limited liability companies. So whatever income they've made for this year, they will pay tax on it in the following year. And it is done once in a year. So it is called direct because we are dealing with the taxpayer directly, and it is paid on preceding year basis. Income of this year paid the following year. Whereas that of payee is paid on monthly basis. That one is actual year basis.
For payee, it is deducted monthly from the emoluments of employees by their employer. Now, what is the method of self-employed persons?
The method is you running your business, you are expected to have a simple record of accounts, okay? So you keep your records, income, expenses, then for the profit you made at the end of the year, you pay tax on it. You fill form every year, and you now submit that form. Then from the details, financial details that you submitted, we, the tax authority, will do the computation to know the tax liability that's supposed to be paid, grant the allowance that is allowed, then the net amount of tax to be paid is computed and served to the taxpayer via a notice called notice of assessment. And with that notice of assessment, the taxpayer goes to pay in the bank, gets his receipt, and comes to the tax authority to update his records and his tax card.
You mentioned form. What kind of form are you talking about?
We are referring to what we call the tax form A. It is statutory for every taxpayer, whether you are in payee or direct assessment, to fill that form every year. It does three things. The form, you declare your income from all sources. You also, there are some claims in the law that you are entitled to claim. You also state it, and there's also some allowances, so that at least there will be some cushion. So that form A is what the taxpayer fills and submit. Now, you can do it online because we have our e-tax platform. So it fills that. When it fills that and submits to the tax authority will now use the tax laws to make sure the allowances that are granted are granted, the reliefs are granted, and if there were any advance payment of tax, which is what we call withholding tax, the advance payment with the tax credit note, everything attached, will be deducted. Then whatever net amount of tax that is left is computed using the given tax rates, and the amount will be stated in the notice of assessment, which is what is now served to the taxpayer. Then the taxpayer goes to pay.
Could you please take us through the procedure for assessment and filing for direct assessment?
Okay. Now, filing comes before assessment. Okay, so now you are talking about direct assessment. So the taxpayer is expected to keep his records. Section 20 and Section 21 of the Personal Income Tax Act talks about deductible allowances and undeductible allowances. So you are expected to keep your records, and it is the profit that you make from your business that is accessible to tax on preceding year basis. We have what we call the tax calculator. We input all the financial information into the records, and there are deductions. There's what we call consolidated relief allowance, but all those deductions are made. Any advance payment, like I said before, of tax is also removed, so there will be net amount of tax to be paid. That net amount of tax to be paid will not be charged to the taxpayer. But the first thing is filing. Take time, fill the form, submit. Once you submit, we'll look at it. If the information are not okay, the taxman has right to get more information. Once we are satisfied with the information, we'll now move from filing to the assessment, which is the calculation of the amount of tax that needed to be paid.
We would like you to take us through that calculation. We want to educate our viewers, want them to know what this entails.
We will look at the figure that is brought. Then we will use our, like I told you, section 20, section 21 to look at what were those expenses that were removed, were they as according to the law, because there's what we call the WREN principle, W-R-E-N, that is wholly, all right, reasonably, exclusively, and necessarily for the business. We apply all of that. So if there are expenses that are not allowed, we add them back. If there are expenses that are allowed, we leave it. So we come to get a figure. Then from that figure, we will now, that is the accessible figure, we will not give relief. If you have life assurance, we have some contribution to pension, we will not give those relief. Then we have the consolidated relief allowance, which is a consolidated amount that is given. So once we remove the consolidated relief allowance, we now got to an amount that is now taxable. They will now look for if there is any withholding tax with the credit note that has been given in his name. We also deduct. They will have net tax payable. That net tax payable will now apply the rates. Okay, the rates are from that amount. Let's say the amount is 3 million. First 300 are 7%. Next 300 as 11%. Then you have 500 follow. You're now at 15%. The next 500, 90%. Next 1.6, 21%. Anything above 3.6 million at 24%. You now add all those graduation figure, that becomes the amount of tax the person will pay.
Wow, interesting. Just like the PE.
Yes, yeah, the same rates.
Yes, you mentioned that filing is now done online because the LIRS has automated its processes. Now, for payment, could you please educate our viewers on how to go about the payments, whether online or they have to visit the bank?
Okay, let me also emphasize that we are in January. It is important that people should know that they begin to filing, okay, and the taxpayer, especially for direct assessment, between January and 31st of March, 90 days, is supposed to filing. Okay. Now, the payments can be done online. If you go to our platform, e-tax platform, etax.lrs.net. If you go to the platform, there are prompts that will guide you on how to pay. You can actually pay online. Once you've gotten the tax liability notice from you, can pay online. You can go to designated bank nearest to you to pay. You don't pay to any of our staff. You pay online, or you go to the designated bank, then you will get a receipt. So with that receipt, it shows you have paid. You will now send that receipt to the tax authority so that your records will be updated. All right, then you have your tax card. You can submit your tax card. We'll now upload it also to your tax card. That's the way it's been done.
We have been looking at direct assessment, the second leg of personal income tax, and we still have with us Mr. Orienru, the Assistant Director, Personal Income Tax at the Lagos State Internal Revenue Service. Mr. Orienru, welcome once again.
Thank you, Amaka.
Now, sir, could you please tell us what the term benefits in kind mean?
For employees, there are different benefits that goes to them. Some of them direct as cash, some of them they have monetary value, but they are not in cash. So those that have monetary value that are not in cash is what we call benefits in kind. They are also known as fringe benefits, or some of them they are called office perquisites, from where you have the word office perks. Okay, so those ones they are also part of their benefits. So they are the monetary value are apportioned and they are added to whatever cash they have directly as part of the emolument, all added up to make the gross income. All right. For example, maybe you have a car. There is an apportionment on that, and some other area. So that is what benefit in kind means. Those benefits that have monetary value, but they are not of direct cash, but it is of benefit to the employer because it's working there. So they are benefits in kind.
Do sole proprietorship and partnerships like law firms, auditing firms pay directors' fee?
Directors' fees are for those directors, mainly for non-executive directors, all right, which is paid to them. It depends on the agreement. It depends on the memorandum and articles of association or the deed of partnership and what was agreed. If there is an agreement from onset that directors of social categories are entitled to directors' fees, so they pay. If it is not, then it depends on what has been agreed upon. But as long as the director is paid director's fee, then that fee will be subjected to tax, all right? But it is under unearned income because it's not like the other one that is earned. But once you are paid director's fees, it's taxable under unearned income.
That's interesting. How do you separate personal expenses from business expenses in assessing sole proprietorship?
I always try to explain to sole proprietors that it is very good for them to keep their records very well, because it is from the profit you make that you pay tax. If you make a loss, you won't pay tax on the loss. So it is good to keep your records, but those records must be properly kept and there must be evidences of those records. Then at the end, from your income and expenditure, whatever profit is made, that is what we subjected to tax. But we don't just subject it to tax. Remember, I mentioned Section 20 and Section 21 of the Personal Income Tax Act. So the expenses must be under the rent test, wholly, reasonably, exclusively, and necessarily for the business. Let's say, for example, the guy is using part of his house. All right? You cannot just pay rent for the whole house and you expect the whole house expenses to go for the business. So what is the portion of that house that is going for the business? So it will be apportioned. All right? So then, and other expense, the list is pretty long in Section 20, that of the allowed and the disallowed. So those are the ones, those are what we guide also. We pick from the financial report that the taxpayer brought. We take up the profit. So every expense that was removed that was not allowed, we add back. Then we apportion only what's supposed to be deducted to be deducted. Then we arrive at adjusted net profit, for which we will now compute our tax and apply our rates.
So it is very, very important for them to keep records, their expenses and their... What is the place of withholding tax under PITA?
Withholding tax is not another form of tax. It's just a mechanism of collecting tax, especially for those that render services, either professional services or they are into any mainly services. Now, what it means is that it is a form of payment, advanced form of payment. So service is rendered, the taxpayer is paid an amount, but the government is saying that for such categories, we have different categories that falls under withholding tax. We have the tables, we have the figures. So those that fall under that, we have professional services, we have contracts, we have, there are many, and the rates are applied. So the person, the taxpayer that is supposed to be paid, the beneficiary, the payer, there are three people involved now. The taxpayer, who is to pay the beneficiary, deducts the applied rate of withholding tax on the amount is going to pay the beneficiary, and remits that amount to the tax authority with a schedule stating the name of the beneficiary. So then the beneficiary gets what we call a credit note, which is sent back to the taxpayer, and the taxpayer sends it to the beneficiary. So the beneficiary, who is the sole proprietor or the professional, at the end of the year when he's filing his returns, we attach all the credit notes And those credit notes, they are evidences of part of the tax that he has paid. So if at the end of the year we've computed and we saw that the taxes that is liable to pay is, let's say, 500,000, I will now saw all the credit notes that he has paid so far is 150. That 150 is already an advance payment of the 500,000. So we deduct the 150 and the net he will pay. So withholding tax is a form of, it's a mechanism of collecting tax in advance. So we gross up everything, we compute, then whatever credit note the person has for that year of assessment, we'll make sure that that is net off, then the difference is what the taxpayer pays.
It is an advantage to taxpayers.
Yes, it helps with your cash flow. It also, so that you don't just have too much outlay at the end. But I always tell taxpayers that they should go back to their supplier or their payer and ask for their credit note so that they can have it as evidence. Because if you don't have that evidence, there's no way you can just claim withholding tax.
Now, finally, before we let you go, what is the place of capital gains tax in assessment of personal income tax?
Capital gain tax is a tax that is chargeable on disposal of property or of other personal assets. Once that is disposed, the gain on it, you pay 10%. Okay? If it's an individual, all right, the individual who makes that gain, he pays 10% on that to the State Internal Revenue Service. But if it's a limited liability company, that goes to the Federal Inland Revenue Service.
Like we said in our introduction, if you run a company as sole proprietorship, that is, one-man business, or in partnership, are you a professional, a lawyer, an accountant, an architect, a surveyor, or even a contractor? What you pay under personal income tax is direct assessment. So go do the needful, and most importantly, keep records. We do sincerely hope that once again we have been able to broaden your knowledge of the workings of the Nigerian tax system. This only happens on Tax Matters. Do well to keep a date with us next week. Don't forget also to watch, like, and follow us on our social media handles. COVID-19 is real. We want you to stay alive. Please stay clean. Wear a mask. Wash your hands frequently. Use sanitizers. Avoid crowds and observe social distancing. I am Chiamaka Ohaochi. Bye for now.